Good morning, everyone. Happy Monday, January 20th, 2025. Donald Trump going to be sworn in today. Very interesting time in the world. Let's hope that he can bring some peace through strength and also some truth. Hope that's not too much to ask. Certainly, those of us in Eastern Europe looking for a respite from the war. Ukrainians, of course, first and foremost, but everybody else who sees the belligerents on the horizon wants to keep it tampered down. So we'll see. We'll see what happens. Going to be a lot of interesting hand wringing and a lot of interesting cheerleading, perhaps more than ever before. But as always, I'd like to try to keep it real here, and let's do another big picture review about something as Mr. Trump comes in here, and that is the money supply of the United States. So we'll go ahead and show you this slide here. Showed this before, but it's always good to give a little update, talk about where we are. This is total United States money supply from the monetary base all the way up to M3. A reminder, the Federal Reserve stopped publishing M3 in 2006, right before the global financial crisis. In fact, very interesting. That's this tomato line here, this red line. Talk a little bit more about that in the video, but we can see here that they stopped publishing M3 February 2006, 2 years, in fact, before the global financial crisis, depending on how you look at it, 2.5 years. Once the global financial crisis hit, we have things look very different. Money supply goes up more and faster. All right. And also on the negative side of this chart, which is going to show what is the base money that's in banks, that goes crazier and grows crazier as well. So what I want to do with this little live stream is to ask the question realistically. Not even going to look at probabilities here. Just look at realistically. You look at this mass of data, this mass of numbers, and ask ourselves if a more constrained money supply is a good thing, because a more constrained money supply would imply slower monetary growth. Slower monetary growth or monetary inflation should lead to slower or less price inflation, as Milton Friedman said. Inflation, as in price inflation, is always and everywhere a monetary phenomenon. If Trump or the people around Trump are able to constrain this beast that is the United States money supply, then what would that mean for Bitcoin, for the economy? And then, of course, the next question to ask is it even possible that he could constrain such a thing? And then, of course, you might want to ask the question, is there a chance that we could have some black swan event, which we had here with COVID 2020? You see these numbers just jump again dramatically, just like they jumped in certain ways after the GFC, but dramatically here, like never before seen on all levels, M1, M2, M3, after COVID. So if we go out till today, and this is a very slow moving metric, unfortunately, have to wait a few months to get the latest quarter. You know, we're in January 2025 and December of 2024 is not released, but I do have September of 2024, which is the first time it's been released in a while. So let's just look at the number 3 there. September 24, M3. You see in the tooltip it says X euro dollars. What's the value? 34.7 trillion. 34,733 billion. $34.7 trillion. That is the broadest money supply that I have been able to replicate and recalculate with the data supplied by the Federal Reserve. Keep in mind, they stopped publishing M3 in 2006. All right. And when they did, they were even miscalculating it or undercalculating it, which is a fact they for sure knew, but they didn't talk about it that way. I've done plenty of videos on that as well. So, $34 trillion. What can we say that this means? Well, you say it says X euro dollars. So this does not include dollars that are offshore of the United States. This does not include dollars that are in Bermuda, Argentina, the Cayman Islands, Hong Kong. There are plenty of dollars there as well. Dollar-based deposits. That's called the euro dollar. Offshore dollars. These are dollar-denominated deposits that are in banks that the Federal Reserve does not control, does not regulate. Okay. I should say right off the bat, that's a huge number, and no one actually knows that number. I've thought a lot about this, by the way, as far as how to calculate euro dollars. You could look at foreign banks. You could look at their assets, like the assets of publicly traded foreign banks. You could make an estimate there of what assets they hold that are in dollars. That would be pretty rough. And plus, it'd just be publicly traded banks. Banks are a huge portion of bank balance sheets are not even publicly traded. You could look at, which is what I probably will end up doing, but I just haven't had the time to get it all together. Most central banks, and I go through this stuff when I do the monetary base update, but most central banks, when they publish their financial statistics, their monetary statistics every quarter, they will delineate between not necessarily dollar-based accounts, but local currency accounts and foreign currency accounts. And so when let's just imagine we're looking at a chart here of the euro area or Japan, Japanese yen. You can also draw these curves, these money supply curves. They also have M1, M2, M3, but those are only using local currency. Okay, it's only using yen, euro, or GBP, pound sterling, if we did a British money supply. And I know I have a lot of British friends. They've been asking to see the British layout as well. I'll get to that. Sorry, I don't have it ready for you today, but we'll get to it. They do actually have their own estimates of what foreign currency is in their system. Okay, and that is not included in their own M1, M2, M3. So you can take that estimate, lump it all together, and then just assume that some portion of that is dollars. In fact, we know that most of it is dollars, just prima facie. And then you could use that as calculating a euro dollar value. But even there, it takes a lot of work, it takes a lot of parsing through, and I just haven't done it. But I will try to do it. So the point is, if we want to think about the dollar, if we want to think about how big the dollar market is, this chart, even though I've worked very hard on this to break it down for you and create an M3 money supply, which, some different people do. John Williams from Shadow Stats, he's done this in the past, although I don't think he's active anymore. At least I haven't seen on his website. There is a huge pool of dollars still not on this chart, which is something to think about. Another thing, by the way, which I don't put here just because it's so small, but it is purely analogous to a euro dollar. That is stablecoins. Okay, so stablecoins, dollar balances that are floating around somewhere in the treasuries of Tether, the Tether company, or USDC, which was Coinbase and Circle for a while. I think they've got other spin-offs of entities that run this. The Binance dollar stablecoin. Those values would also go here because those certainly are tokens that trade like money, stablecoins, and they certainly go here. Now notice, it's not actually very big yet. Okay, so to me, that's a huge point if you look at this chart. I'm showing you a chart that has 34.7 trillion as the max value, 34.7 trillion. And if you put, like if you could imagine just layering in a little area for stablecoin balances, it would barely show up on this chart. 100 billion, 150 billion versus 34 trillion is nothing. Notice that the M3 is 34.7 trillion, 733 billion, just in the sort of in the decimal. If we were speaking trillions, 34.7 trillion. Stablecoins are about a seventh of that decimal, right? 150 billion. It's just actually not a lot, but they are completely analogous to euro dollars. So, my point there is to say that there seems to be a lot of room to grow for stablecoin appetite if there's such appetite for dollars. Now, everybody watching this live stream at the moment, thank you. Let me know if any questions. I know you, as I know, that we're happy with the little pump in corn today. We're happy with positive pro-Bitcoin sentiments that could come out of the Trump administration. We want to stack sats all that we can. But we also have Trump coin on Solana. David Sachs, no friend of Ukraine, little pet project. We have a plethora of other shitcoins to contend with. And we have all of these dollars to contend with. My point is, even though we may feel that we can see the light, the forest through the trees, we can see that Bitcoin is the apex predator here. Bitcoin is still a flea. Even if we look at the United States monetary system, Bitcoin is huge, no doubt. Bitcoin is, by the way, about the size of M0 on this chart. Bitcoin is $2 trillion market cap, which is remarkable. It is, I hasten to say, it is remarkable. But if you consider the power growth, the power regression trend line, even if Bitcoin is the size of this zero, which I'm highlighting now, okay, M0, on the chart, it's still very, very small as a component of all dollar-denominated balances in the United States economy. And remember, consider this doesn't include stablecoins, not that big of a pie anyway, and it doesn't include euro dollars, a huge pie, a huge portion of dollars that are not recorded here. Okay, it used to be included in M3, by the way. Euro dollars were theoretically in this red line, but I don't think they were even calculated. In fact, I know they weren't calculating it correctly then because they've admitted as such. So I've removed euro dollars entirely. I don't have a good benchmark for it yet, a good estimation for it. Maybe I'll get there at some point, but just think about that in the broad story of how money grows. This is the dollar, strongest currency in the world. Trump loves it. Trump's not going to let it go. He's going to influence Federal Reserve policy best he can. Whatever. We'll see how he does. As much as all of us would like, hyper Bitcoinization to come next week when Trump is in office and he hopefully embraces Bitcoin clearly, we'll see how that goes. Even if that would happen, even if he said, I'm buying Bitcoin every week, there's still going to be dollar balances here. You're going to see you would see a major shift for sure, but I don't see the scenario. I don't see the probability of Bitcoin's market cap moving into, let's say, the value of M3, 34 trillion, anytime soon. I do see it happening in the future. As we talked about, the global monetary base is 27 trillion. It doubles roughly every 6 years. So in 12 years, it's going to be 54 trillion. 6 years is the fast rate. By the way, I got a couple different rates to calculate the growth. You can make cases for both, but I'd say 6 to 7 years. 6 to 7 years, it doubles. So that 27 trillion global monetary base, right? That's all currencies. That's going to double in 6 to 7 years, double again to 100 trillion in 12 to 14 years. That is, and indeed, that is that magical number, 100 trillion. Other people have used that number more aggressively than I have. That seems like an interesting number to look at 10 years from now. But now, right now, no matter what we hear, what we think about in the news, people hate Bitcoin, they love Bitcoin. I just don't see it. The monetary base, by the way, how does that look on this chart? The monetary base includes M0. Again, what is M0? M0 is not the monetary base. Sometimes people confuse that. M0 is just physical cash outside of bank vaults. Okay, physical cash and coin outside of bank vaults. Coins are a very small percentage. So M0 at the moment, $2.3 trillion. This is actually September. It's higher now, I'm sure. But I'm just looking at this thing on a quarterly basis. 2.3 trillion. That's at M0. Physical cash outside of bank vaults. The rest of the monetary base is below the line. It's bank reserves and vault cash. This black, really deep black area. All right. Put those two numbers together. All right. So I know it's negative, but the reason it's negative is just to show it negative. It's not negative in reality. Just keep it in mind. 2.3 trillion plus 3.3 trillion. There's your monetary base for last quarter, $5.6 trillion. So that's the United States' monetary base, the monetary base of the dollar. And we add the rest of the global currencies. They have their own monetary base: Chinese yuan, European euro, Brazilian real, Japanese yen. You get to that 27 trillion figure. So these numbers hopefully can help you figure out the arena, the monetary arena as it stands. This has been one of my goals in life, is trying to figure this out. And I'm far from saying I have it all figured out, but at least to paint it in a picture which is understandable. It's enormous. It's enormous. It is amazing, again, to say that M0, just as a number on its own, all right, that's all the Federal Reserve notes and all the coins that have been minted by the Treasury. Both are minted by the Treasury, in fact, or Bureau of Engraving and Printing, but the Federal Reserve has sole jurisdiction over notes, the Treasury over coins. Coins don't matter. Even notes don't matter, as we know, but still, it's huge. It's a huge number, all right? M0, the notes and coin outside of the Federal Reserve, outside of banks. That's a huge, that is a number that Bitcoin is about to reach right now, 2.2 trillion. Actually, what is the market cap with this pump? The market cap with this pump that Bitcoin just had this morning, it's going down a little bit from the pump, 2.1 as of this recording, 2.1 trillion. So it's a remarkable run. It's a remarkable thing what Bitcoin has done. It's almost matched M0 of the United States. Not the monetary base, but M0. It's incredible. And as you know, there's only 4 monetary bases that Bitcoin has not passed. It's passed the 5th largest this past year in 2024. It passed the pound sterling, which is about $1 trillion equivalent. 1.1, I guess. Bitcoin is above that. So that's the layout. That's sort of what I want to reiterate here. As much as we are, I hate to use too many bad words on this show, on the live stream, but as hardcore as we may be about buying sats, there are always going to be surprises. And this is if Bitcoin, like in my opinion, still, if you look at this chart and specifically, let's just take off everything but M3. I can explain more if people have questions about what are the other ones, but so we'll leave this. Central bank money is here, right, in black, but the bank money is in this lightest green color, M3, X euro dollars. George Selgin calls the bank money, that is the black reserves. He calls this the Pied Piper of the system. Okay, so it's the sort of the thing that keeps the system moving. But the system itself is in green. It's M3. All right, so is one more important than the other? Arguable. I've always been a fan of looking to the core of the system, looking at base money. So base money is included again in the black. Remember, it's M0 plus the vault. But the system is the number 3 there. It's M3. So we have to ask ourselves, and again, this is just the dollar. This is just the dollar. So roughly, since the dollar is 20% of the global monetary base, okay, $20 a little over, let's say close to 6 trillion. Global monetary base is 27 trillion. Dollars roughly 20% of that, okay? It's 20% of the global monetary base. We could roughly say that, you take this number, M3 of the United States, multiply it by 4, you'll get the global M3. It's actually, I think, a little bit less than that, but I haven't looked at it lately, and I'm sort of haven't fully made a global broad money the way I've made a global narrow money or monetary based money. Let's just call it 120 trillion. Okay, 120. Let's call it 125 trillion. So if the global system of money, of liquidity every day that's needed to settle transactions, to pay for bond payments, to pay for coupon payments, on both sides. When you raise money, you get people's bank money. When you pay them back in bank money. It's a huge pool of capital, $125 trillion, which, by the way, is way smaller than global debt, global equity value. It's actually probably about the size of global equity value, but it's, the debt markets are over 300 trillion. All debt. Government debt, corporate debt, private debt. And then you could add on things like, private company enterprise value. You're getting into the hundreds of trillions of dollars. So there's a lot of, the numbers are huge. They get sort of mind-bogglingly big, and I don't have, nice curves of each of them. But I do have a nice curve of the M3 money supply, which is, let's just say, 1/5 of the global money supply. It's probably more because, again, you think about the dollar, it's huge. It would make sense that it's not pari passu with the base money percentage, okay? Because, there's a huge number of Chinese yuan in base money, but not as much in broad money because no one wants to hold the yuan. The yuan's mostly for the local system, right? So in any event, the dollar is a huge component of the global monetary system, but the global monetary system is huge still. Now, I've always said that Bitcoin it's probably not going to overtake broad money, okay? Even if we get into a full Bitcoin system, I don't want to get too theoretical on this live one, but even when we get to a full Bitcoin system, you still can have derivatives of Bitcoin that we trade. Even if it's something as simple as a derivative, a future or an option, right? We're cash settling things that are not Bitcoin, but they're based on Bitcoin, they're priced in Bitcoin. You can do that, even in a full Bitcoin system. That means you have leverage, all right? So this is leverage, by the way. All of this green, huge green number is leverage on the black. The black is the actual thing. It's the corporeal thing. It's the bank money. It's a bit confusing, some is just for banks. That's why it's negative here. Some is for the public. That's why it's positive. But if you add them both together, you get about $5.6 trillion. The $35 trillion is leverage on that. So, again, I think that this leverage will continue, actually. Not that I don't believe that Bitcoin's going to be awesome and give everybody a better sense of themselves, a sense of their personal balance sheet, a sense of how you can, think about how much governments print today. If they knew that there was this scarce Bitcoin floating around, just like there used to be scarce gold back in the day, they will think twice. I think that's absolutely true. They will think twice. So there's all sorts of great benefits that are coming from Bitcoin, but to ignore the financialization of this M3 number, I would say, is a mistake. And my conclusion there is don't get too wrapped up in these price moves. Okay, again, go back to Plan C's, percentile, quantile regression, CINA. I'm going to be on their show, by the way, this week. Talk a little bit more about that. Look at my multiple regressions. I did some on that earlier this year. Probability distributions, probability mass of what could happen in the future based on the past. Bitcoin getting up to 1 million is theoretically almost impossible based on the numbers this year in 2025. I'm not saying it won't happen. Theoretically, it's almost impossible. So this is just kind of, I thought this would be a good chart to show today because it, in my opinion, it adds to that thesis. All right. It took a long time. It took since this, remember, Bitcoin started in the wake of the financial crisis. So it took again, not even thinking about trend lines, but growth rates. It took the entire period here from 2009 to now for Bitcoin to equal M0. M0 was growing pretty constantly. All right. It was 800 billion, 900 billion in 2008. Now 2.3 trillion. With a big bump, by the way, let's take off M3 and let's take off with a big bump, as we can see. And I'm looking at the positive number here, the 0. Big bump, to be sure, during COVID. All right, it was 1.7 trillion just pre-COVID when Trump was still in office, and now back in office, 2.3 trillion. So the point is, it's just it's an oil tanker like thing. It moves very slow, and for Bitcoin to just blast all these things out of the water, to obliterate it, I don't see it. I just don't see it. I think it's going to take time. We're going to have Trump talking about the dollar. We're going to have people wondering how oil is going to be priced, natural gas. The U.S. is becoming a big supplier of that again to the world. That you're pretty sure they're going to not want to be paid in Chinese yuan. It's just an oil tanker type stuff. Michael, thanks for the comment, asking about the rate of increase of the money supply. It is indeed. So for this money supply, that is M3. If you looked at the start of M3 back in January 1959, $292 billion to today, 34.7 trillion, or September. My calculation is 7.6%. And that's not my calculation. That is the calculation. But it is to extent my calculation because people aren't going to give you this. You have to work kind of hard to create this number that I did. 7.6%. That is the compound growth. 7.6%. Okay, so that's a doubling a little faster than 10 years. Remember, if it was 7.2%, it would double every 10 years. It's 7.6, so it doubles every 9.4 years. The growth, now that's broad money, okay? Now, you might think that that's actually faster than the increase in base money. But now let's look at base money. Let's take off Fed repos. I'll talk about Fed repos in a second. It's the dark gray on the negative side. I'm taking it off. This is the monetary base. Okay. On the top side, public money, the cash, plus the negative side, this is bank reserves, which again, just were a non-issue. Nobody even thought about bank reserves before the global financial crisis, before Ben Bernanke went wild in bailouts. Nonetheless, the growth of these two things put together, it's a monetary base. That is 40 trillion, roughly 40 trillion in January 1959, now to 5.6 trillion today. That growth rate is like 8.9%. 8.9%. Okay, so an 8.9% doubling is even slower than 10 years. Let's put it, whoops, hold on. Actually, it's not slower than 10 years, it's faster. Brain hiccup there. It's 8.1 years. 8.1 years. That shows you the craziness of compounding. 7.6% compounded doubles every 9.4 years. 8.9% doubles every 8.1 years. So it's faster. So this money supply, point being, especially because of this black craziness here, this money supply grows faster than this money supply. All right. This money supply grows at 8.9% per year compounded, the United States. Remember, the global monetary base grows at 12.7. Okay. But this money supply at 8.9% per year compounded. This one grows at 7.6% per year compounded, M3. So it is true, regardless, 7, 8, 9%. That is what America's money supply grows at. And for sure, if the Federal Reserve is growing their balance sheet that way, which is the black, or if hedge funds, banks, and pension funds are growing the balance sheet at 7.6, which is green, light green here, you better be sure that you're growing your personal balance sheet by at least 7, 8, 9%, which, bear in mind, is it's double the amount of what they say inflation is, which is usually 3 or 4% per year. The Fed targets 2%, which is insane. It's not, they don't target that. They don't achieve that at all. And the 3 or 4% is like a fake number. It's no free real estate, that number. And bonds have always been less than that anyway, right? Except for the 80s. But mostly, bonds 4, 5, 6%. So I think you should be closer to the 7, 8, 9% for sure, at least. And then stocks, as we know, in the last few years have been higher than 10, 11, 12%. The all-time average of stocks is 9% with dividends reinvested on the S&P 500. So a lot of percentages, but bottom line, we smooth that out to that 10% compound annual growth that will double every 7.2 years. So thank you. Thank you for the comments there. Appreciate it. Thank you, Granger. I do think, I really do think that, there's a lot of bombast out there. There's a lot of people, they want to sell you stuff, which is, that's like the biggest thing, right? It's just, there's so many grifters. This stuff's going to keep growing. Like, think about here. Let me show you an example. Let's take off M3. Here's monetary base. Sometimes it's good to have this both as a positive number, but I don't have it at the moment. But let's look just here. Look at these two numbers together. 1.2 trillion plus 2.8 trillion. Okay. So that's 4 trillion. That was kind of the peak after the heady Bernanke money printing days. It was $4 trillion balance sheet, $4.5 trillion balance sheet. Okay. And then look, even as the currency was growing, the bank reserves were falling. They said, okay, enough of this. We got to normalize. And they were able to get it down to here. And let's now add these two numbers together. They did shrink it. This is actually a net shrinking of the balance sheet. So they did shrink the money supply, amazingly, after all they printed, to 3.1 or 3.2 trillion. So they went from 4. They went from not even a trillion here. It was like 900 billion, 850, 900 billion just before the crisis, to 4, over 4, down to 3.2. First of all, it's like wacky. All right. All this was done in the name of bailing out banks and hedge funds and money market funds. But they couldn't sustain it. And a black swan just destroyed it. After COVID, it's just destroyed. And even if you look here, I've mentioned this a lot. There was a repo spike. I need to get the percentages up here, but the repo markets, which is another way to trade these bank reserves, by the way, it's another way to trade this black thing. Even though you don't see much happening in the black thing here, like this, it was decreasing. Right here in September 2019, there was a huge spike. Went from trading repos at a couple percent or less than a percent, it's overnight reserves, right, to over 10%. It was a huge spike. It showed that even though it was like massive amounts of liquidity in the system, still, that was not a lot of liquidity. Like they got scared. They did not want to part with these reserves, banks and hedge funds. So the repo rate spiked. It was a huge signal. And you can't really see it because the craziness of COVID dwarfs it. But like here, right, you see it's growing again. And I know it's negative, but it's the best way to show it. It's getting bigger again. You see it right here from September. It was I'm looking at the negative number now, 1.5. It goes from 1.5 to 1.7. So I got 200 billion more in reserves here between September and December 2019. That was before COVID, before the craziness. That showed that even there, all was not well in the financial markets. But again, even with all that craziness, Bitcoin didn't, explode. It did go up a lot. That was the big year coming into, actually the year after COVID, 2021, Bitcoin goes up to 60 grand. It certainly is related, and it probably will get more related to the growth of money supply. I don't dispute any of those things, but it's going to take time. That's the thing, is it's going to take time. Let's take off the bank reserves. Now we're just looking at public money again. Just another thing to keep in mind. Look at that. This is just what you see in the green. So M1 includes everything in M0, but more stuff. So it means it includes all the cash that's outside in the system and grocery stores, under people's mattresses and safes, but also includes this. What is this? This is demand deposits. So this is the helicoptering of money. Literally demand deposit. Subtract them for demand deposits. So demand deposits were 5 minus 1, 7. Demand deposits were 3.2 trillion here on the eve of COVID. Then they went to 9.5 minus 2 to 7.2 trillion here. So they doubled. Crazy amount of money printing. Crazy amount of money printing. And they have cooled it off. Interestingly, they have cooled it off, but still, Bitcoin didn't explode. Bitcoin didn't go parabolic. I'm not saying it can't happen, but the probabilities say it doesn't look good. And then if you had M2, this is just like more savings accounts, other things. M2 is not that interesting. It's funny, actually, because if you look at like people on Twitter or whatever who all that they see is the broadest money supply, which is M2. M2, again, is not the broadest money supply. This is just all the retail type instruments that people can hold. So savings accounts, time deposit accounts. When you put your money on deposit and you can't take it out, that's in here. That's an M2. Money market funds for retail. If you don't want to know what a money market fund is, it's just like a stable coin, basically. So usually you have it in your brokerage account. So if you see cash in your brokerage account, it's usually a money market fund. You don't see it that way. You don't think about it that way, but that's what it is. It's a stable coin, basically. It's a money market fund, which takes your real dollars, buys treasuries with it. So immediately those are gone from the M2 system. But what they put in return for buying those treasuries are they give you this balance, this money market fund balance, NAV, net asset value. So that's here as well in M2. But that's not the broadest money supply. So the Fed was so disingenuous to cut this off in 2006. This is the Fed's M3 money supply. So what is M3? This would add up M2 and M1 and M0, but also include institutional, less liquid instruments. So institutional time deposits, large time deposits, institutional money market funds. And when I say less liquid, I mean less like a Federal Reserve note, right? It's farther down the stack. You got to get your money out of the brokerage account, get it back into a bank account, so on and so forth. Also includes repurchase agreements. Repurchase agreements are a bit confusing, but basically what they are is it's like a treasury, United States Treasury, but it trades around like cash. Okay, so it's a hedge fund levering up a treasury, and the act of doing that lets the hedge fund buy more stuff. That's what it is. So if you put in repos now, and this is it's an institutional type product. You and I can't repo stuff. If you put repos in, you get this. So this is the sort of one level of M3, higher than M2. And then if you put in, this does not include repos still. This does not include repos. What this is large time deposits and institutional money market funds. That's what this is. Okay. Then if you put in repos, you get the lightest number that I had. That's this. So this is how I build it out. You got to do it step by step. The repo number, they have just been terrible at. They weren't even calculating correctly here. The reason it doesn't even match, you can see that their M3 is lower than mine, backdated, back-tested, is because at the time, they were only including repos in banks, like banks that were repoing stuff. But really, repoing doesn't even happen in banks. It happens outside of banks. It happens with hedge funds, money market funds, pension funds, institutions that want to lever up further. So it just shows you like they haven't even had control of the money supply. And the only way that I am able to calculate this data, of course, is by using their data, which they've been forced to by Congress sort of analyze and do more. But no one puts the whole picture together. No one just shows that, like, Christ, they didn't even calculate M3 correctly before they discontinued it. And their M3 number, by the way, includes Eurodollars. It's their definition of Eurodollars. I'm sure it's understated. I'm sure it's undercounted. So it just shows you it's crazy. It's crazy how, if you want to put all this stuff together, it's difficult. And, no one pays attention, in my opinion, to these things. So here's another thing I wanted to say. If we let's take off the sort of mid-level M3 thing, which does not include repos, but it does include institutional money market funds and large time deposits. So this is now basically the difference between M3, M2. So non-M2, M3 money is the lightest green area. This includes repos, institutional time deposits, large money market funds, all the big crazy dollar balances. This is something that I think is interesting. I've heard no one analyze this. And I'm not saying I know how to use it as prediction, but look before the GFC. What was happening to M3? It was clearly growing. The delta between M2 was growing. Okay, so here, let's even take off the Fed because the Fed was wrong and they stopped publishing it. My M3 with the data that we have now. If you look in like 1993, the delta between M3 and M2 is $1.3 trillion, $1.2 trillion, $1.3 trillion, $1.2 trillion. The delta on the eve of the global financial crisis between M3 and M2, 9 trillion. So you can clearly just see with your eyes, we don't have to measure growth rates. When M3 gets crazy, things get risky. Okay. Global financial crisis hit, M3 cooled off. They stopped all the crazy lending. Still didn't get back down to this level in the 90s. The delta was still 7-8 trillion, but you can see at least it cooled off, right? Now let's look at today. So we still had a lot of money printing from COVID. Doesn't look that extreme when I zoom in, does it? You can see it more here, but I'll zoom in here. So let's say here, before COVID, M3, 21 trillion, M3 without Eurodollars, mind you. 21 trillion M3, 14 trillion M2, roughly 7 trillion. $7 trillion is the M3 delta. Non-M2 money, that's in M3. Institutional money market funds, repos, large time deposits. $7 trillion. Now, let's grow it through the massive money printing that happened in COVID, which most of it happened, by the way, in M1. See, M1 grew like a huge, also in M2, but a lot in M1. Growing this out. We're looking at the difference between M3 and M2. We get to the end of last quarter. Now it's about double that difference. 13, almost $14 trillion. Okay, so it was 7. Now it's almost 13 trillion. Again, I don't have a hard data numerical conclusion here for you, but if you want to talk about being careful, I would say when the light green area spreads apart from the darker green areas, which is M2, historically, at least in the case of the global financial crisis, things didn't turn out well. And it's happening again. It is happening again. What else to talk about on this chart? Let me know, guys, if you have any other questions. Go back to the bank money, central bank money. It's in the negative here. So we have the let's take off the broad. Oops. Go back to the central bank money now. Okay, monetary base. Positive side M0 is what we can hold. The negative side is what banks can hold. They collateralize all that on top of more lending, more credit. Let's add now repos. What are repos? This is where the Federal Reserve itself engages in a repo. Okay, so it's a very bad practice, in my opinion. It's basically where the Federal Reserve kind of acts like a lender of last resort to money market funds. Okay, because money market funds are usually the ones that hold the asset of a of whatever they're creating their token against. Okay, but they hold that with usually, like a bank or a hedge fund. Here they hold it with the Fed. The Fed. All right, so the money market fund's asset has become the Fed's liability. So again, this is a layered chart, so we got to do some addition and subtraction. But if we add Fed repos, we see that here, during COVID, a huge chunk of change went into the Federal Reserve. So let's just say the most extreme delta now, right, where the black area is smallest relative to the dark gray that's negative, is probably here, right? It's not here actually during the start of COVID, but somewhere here. Let's look at that difference now. So here we see the bank reserve portion and vault cash that banks had in the system was 3 trillion, 3.1 trillion. You add in Fed repos, the total is 5.5. You got to subtract it. It's just how we got to do it in this chart. The difference is 2.4. Okay, so that was somewhere around 2.4 trillion was the max Fed repo value. Now, what did that mean? It meant that the Federal Reserve was basically, instead of buying treasuries directly, which they also do, and sometimes they did that with the Treasury General Account, which is also there, but I didn't put it on here. It extends this a little bit more if you talk about the total balance sheet. They buy treasuries, and instead of buying treasuries from banks, which they do primarily here in this black shaded area, they would buy them from money market funds. So it's not no one really noticed it, you could say, but what it did is it made money market funds feel safe because their counterparty is now the Fed, all right, who has infinite, like their bank reserves. If you have an account with the Fed, theoretically, that's the safest account in the world. It's the safest bank account in the world. It's with the Federal Reserve. So money market funds could now go to the Fed and they could sell their token to the Fed. And that's basically what was happening. Now, the token wasn't necessarily in the form of a money market fund balance. It was what is called a repo, right? So the Fed was repoing up or levering up the securities that they had bought in the past. It's a crazy thought experiment, but basically they were levering up their own treasury securities and using, instead of the money market funds having that leverage throughout the system generally. Like, let's go back to the example of you and I putting cash into our brokerage account. The brokerage typically would take that. It would have you would have a brokerage balance, say a money market fund. The broker would take that liquidity and buy a treasury, and then they'd get the interest from the treasury. They'd earn a yield, right? They could do other things, long and short, whatever. But a repo would be if they would take that treasury, all right, and leverage it up further. That's basically what a repo is, okay? And money market funds can do it, but typically they sit on the other side of the trade. Who levers it up are hedge funds, pension funds, primarily hedge funds. But banks also have done it. Not a huge portion, but those are the ones that repo treasuries, basically. And so that process allows them to buy more, do more. Could be short more, could be long more. But the fact that what you see here with this with Fed repos number, this 2.4 trillion, is this is the Federal Reserve getting in that game. It's like bizarre. Like, why would the Federal Reserve need to do that? The Federal Reserve already holds the treasuries. Why would they need to lever them up more and sit with a larger liability on their books? It's a good question to ask. As you can see, it's come down, this process. They've sort of cleaned it out. As of now, the difference, 4.1 trillion with Fed repos, bank reserves, and vault cash, 3.3 trillion. So you got about 800 billion, roughly, in Fed repos now. So it's a lot different. That's a third of what it was here when it's 2.4 trillion. But there's no saying, now that this genie is out of the bottle, it's just like this genie was out of the bottle here. It's net, this is all that it means. No one could have imagined the Fed would bail out the system like they did here. That's what they did. And then they started to basically bail out money market funds here and other hedge funds here. Why did they do that? Anybody's guess. But it's more distortion. It's more distortion on the system. So I might have spent too much time in this idea, but yes, the Federal Reserve can certainly distort the system, cause more dislocations than it solves. And certainly people posited that they did that here, taking so much, taking this leverage onto their books. And again, it's not really leverage. I mean, it is leverage against the dollar, you can say. Like, if they have too many liabilities, then the dollar becomes worth less, right? But that's what they did. That's what they did. Just more soft support for all actors in the system when they struggle. Another reason, of course, is that they put a floor on repo rates. Okay, that's another reason, right? Just like I said here that the repo rate spiked, right, back in September 2019. They weren't intervening as much, by the way, you can see in the repo markets themselves. They still are kind of in the markets with the black because it's a big circular thing. I mean, banks are repoing, money market funds are repoing, but the Fed, it is true that the Fed itself wasn't intervening a huge amount. Okay. But here they were intervening directly in the repo markets. And what they do then is they put a floor on repo rates. Just like here, they put a floor on treasury rates, right? The yield for treasuries would have gone higher. That is, the price would have gone lower had the Federal Reserve not done these things. But since it stepped in, created demand for those assets, it kept, as they say, interest rates or yields artificially low or prices artificially high. It's the same here. It's just the repo rate is one step removed from that leverage. It's just more leverage. It's more leverage at the end of the day. So it's probably a little bit more than I wanted to say about the repo and the Fed. But just in case you're wondering, I literally have all slices of the pie here. Okay, when the Fed is in the repo market, or when the repo market happens just with sort of non-Fed actors. That's here, by the way. That's the difference between these two threes, okay? So if you look at that, if you want to know what the repo market is, it is about 6 trillion at the moment, 6.3 trillion. It's certainly been higher at other times. Not 6, yeah, 6.3 trillion. 34 trillion, 30.7 trillion minus 28.54 trillion. Okay, so that is the size of the repo market. And then the Federal Reserve has sort of intervened in that market here to the tune of 2.4 trillion. Actually, there to the tune of 2.7 trillion. 2.7 trillion was one of the. So, gives you a flavor of how the Federal Reserve interacts with different markets. But if we just want to take all that off, look at it simply. Thank you, Wolf. I'm on Nostr. I am on Nostr. I need to post more, but I am there. And I even have a Nostr server, however you call it, so I can even host videos there. But as far as going live and stuff, I haven't figured it out. So let me know if there's a way to do it, but I will try to do it more. So net, after all that talking about the money supply, let's take off everything but the biggest negative and the biggest positive. How about that? This number, one could say, if you added these two figures together, is the total leverage. It's the total monetary value of the system. One could also say, if you took, say, this broadest M3 number divided by the negative number that I have here, it's total leverage. Okay. So 30.7 trillion. Actually, you got to subtract M0. It's complicated. I know it's confusing, but you'd have to take 30. Let's just do it. 34 trillion, 34.7 trillion minus 2.2 trillion, because that's Fed money anyway. It just sits outside the system. It's not part of leverage. So 34.7 trillion minus 2.2 trillion, it's 32.5 trillion. 32.5 trillion. All right. And you take that divided by 4.15 trillion. So it's 8. It's roughly 8. 8x. That is sort of total system leverage to the Federal Reserve. And that you could define that different ways too, right? The M0 I'm not counting at all, just because it's like just cash. It just sits there, right? It's like non-interest bearing. The Federal Reserve prints it. It matters, but I'm not. Sometimes you could put that in the denominator. I didn't. Whatever. It'll be smaller than in that case the leverage. But let's leave it at 8x. So that's the leverage of the system. Is the broadest money supply divided by this basically total Fed balance sheet number. And the point of all that is Bitcoin is still to this day only 2 trillion, 2.1 trillion. Trump's going to love it. Let's see how it goes with taxes and friendly Bitcoin policy. But again, that's still not the world. That's not how Bitcoin works. Bitcoin is global money. And like I said, the global system is probably at least 4 times all of these numbers I just told you. Okay, so the monetary base is indeed 5 times. Okay. And the global broad money, let's say it's 4 times. 120 trillion. Thank you, NGU. Appreciate it, guys. That's all I really had. Unless you have other questions, hopefully I answered the basic ones here about repos, money market funds, tomato lines, M3 money that the Federal Reserve doesn't even post anymore, which is a blasphemy in itself. The system is very levered, yes. Doesn't give anybody confidence. Certainly looks different than like here, right? Even though that looks pretty steep on the M3. bailouts occurred, lots of leverage, lots of money printing, but I don't see in the next year. I mean, Bitcoin, it would be very rare for Bitcoin to go to a million. See my other charts for that. I'm thinking more like 250,000 or so on the top end. Never financial advice. Even if it did go to a million, it's a very, like, then you're talking a just total transformation system-wide event, which would destroy the dollar if it stayed there. Usually it doesn't stay there when it goes to these extreme values. So that's what I see. I see in the next 10, 12 years that sort of power curve growth for Bitcoin, exponential growth here, $100 trillion monetary base in 12 years. Very well, Bitcoin could match it there. Thank you guys for watching. I will try to be back here tomorrow for another one. Take care.